I don't have time to go into my full story and all of that sort of stuff today. As I said, I'm challenged already to do this in under an hour. However, I will say this. My introduction to business was not a successful one. I'm from Melbourne originally. We went into a business-to-business call centre down here. I was aged 18 when I did that. And it was a terribly unsuccessful and stressful introduction to business. And it took about 2 to 3 years and a lot of money that we didn't have. To learn some really important lessons. But the game changed for me when I started to view business differently. The game changed for me when I started to view business differently. And I can remember the moment where I sat down and I started to ask myself questions that I hadn't asked myself before. I'll give you today's equivalent. I started to ask myself questions like, how does a Janine Ellis start a juice bar out of her lounge room and within 10 years sell 65% of it for $70 million? How does a guy called Creel Price, who's a friend of James and mine, how does a guy called Creel Price start a business with $5,000 and a business partner and sell it 10 years later for $109 million? Anyone heard of a small company called Virgin Blue, by show of hands? A couple of people, now Virgin Australia. Who knows how much Richard Branson invested into Virgin Blue to start it? It's $10 million. You'd think it'd be 40s, 50s, 60s to start an airline. $10 million he invested into Virgin Blue, and in hindsight, who is now just a legendary CEO, a guy called Brett Godfrey. So they invested 10, 3 years later took it public, with the exception of that gentleman there. Does anyone know how much they floated it for? What the value of the business was when they took it public? WHK people are also excluded from this question. Does anyone know? Let's have a guess. If it was 10, and it's 10 initially, 3 years later, what's a reasonable ROI? 70? Who's happy with 70? Invest 10, 3 years later, get 70. Who's happy? Show of hands. No, you greedy bastards. Wow. It was higher than 70. 200?
It's 2 billion.
Hey. You sort of ruined the punchline there, brother. Invested 10, 3 years later, floated on the Australian Stock Exchange for $2.3 billion. Who's happy now? Show of hands. Okay, good, just so we're clear. Now, he didn't own 100% of it, but who cares? He owned 29.6% of it at the time they floated that business. So he turned 10 into whatever that is, 800-ish, yeah? So what I started to realise is, you know, as I sort of started a second and third business, I started to, you know, make relatively good cash flow out of the businesses that I was involved in. But I certainly wasn't making 7 figures, I certainly wasn't making 8 figures, and I definitely wasn't even thinking 9 figures. And what I realised was that the core difference between the people that were playing that level of game and the people that aren't, of which I was one, is that the people that are playing that level of game are focusing on one thing. And I want you all to write this down. This is what we're going to start with today. They were not focusing on cash flow. They were not focusing on their website primarily. They weren't focusing on any of this sort of stuff. They were focusing on one thing, particularly as they came out of the startup phase. Their focus shifted to one thing. It's a 5-letter word that starts with V, and that is value. They were focusing on building the value of their organisation, of which cash flow and profitability is only one driver. It's only one metric in a whole bunch of different sort of drivers of value, of which we'll go through today. This might seem like a stupid question to ask at an event like this, but please put your hand up if you're looking to raise money in the next 18 months. Okay, cool. You guys that put, so I'm just going to assume that just about everyone's looking to. Why might we want to raise money from investors? Just yell out the answers. Why might we want to raise money from investors? What are, yeah, totally. To facilitate value. Why else? Yeah, totally. Accelerate growth. What else? Someone from over there? Yeah, totally. And what would we be investing in? Totally. Yep. So people, infrastructure. What else? R&D, thank you. R&D, research and development, yep. Marketing, perfect. Marketing and distribution. I'll take one more. Licensing, totally. Okay. Guys, you know, through MBE and Entourage, we speak to over 10,000 small businesses every single year. In our community, we've got about 18,000 small businesses. So we really back ourselves to understand what are the core obstacles and objectives of small business owners all over Australia. In my experience, people look to raise money, and all of these fall under these two umbrellas. In my experience, people aim to raise money for one of two reasons. I'll get you to write these down as well. Just write it on the back of a piece of paper or wherever we can. One or two reasons. The first reason is to accelerate growth. They want to go out in the marketplace and create more demand. We want to spend money on a marketing campaign. We want a more aggressive online marketing campaign. We want a sales team. We want a bigger call center. We want whatever it is. We want to spend some money on advertising. We want to engage a PR firm, etc., etc., etc. We want to go out there and accelerate growth and create demand. The second reason, which is sometimes less obvious, is that businesses will raise money to facilitate existing demand. So one is to create demand, one is to facilitate existing demand. Meaning we're growing so quickly, Jack, the last thing we want to do is spend more money on marketing. We literally would implode, we couldn't handle it. However, we've already got the growth, therefore we need to put measures in place and put things and people in place to facilitate that existing growth. We need a bigger warehouse, we need more product at hand. You know, we had a company in the BRW Fast 100 come to us 2 years ago. They needed to raise $2.2 million. And the last thing so Fast 100, right? So the growth curve was about as steep as you could possibly get. Last thing they wanted was more marketing. They needed a bigger warehouse. They needed more product at hand. They needed cash at bank so that they could take advantage of buying opportunities. They needed a CFO. They needed a CEO. They needed call center staff. What else do they need? Down the track, they sort of at around 2, they might look at acquisitions. But primarily, it was about bolstering their existing business just to cope with the existing growth. What I'm trying to get across is capital raising is not about capital raising. Yeah? Capital raising should simply be a function of building one thing. And what was that? Value. Yeah? Whether we're looking to accelerate growth, increase profitability and increase revenue, or invest in people and infrastructure, or do some R&D, or more marketing and distribution, or look into a licensing play, whether we're looking to do any of that sort of stuff, it all comes back to building value. So today we're not really talking about capital raising. We are, but we're not. What we're really talking about is a function of how do we build maximum value in your business, hopefully so that you can one day sell it for the highest possible price. Now, some of you won't want to sell your business. That's completely cool. We can still do everything that I'm talking about, and I might sort of touch on that as we go through. Okay. So guys, in order to launch a successful capital raising, we need to know and understand 3 primary things. Firstly, we need to understand what are the drivers of value. How do I influence and impact the value of my idea or startup or growth stage or existing business? How do I influence the value of the business? No different to if I was to buy a house and renovate it to increase the value. Your business is an asset. It shouldn't just be a vehicle to generate cash flow and profits. You need to start looking at it as an asset, of which profits is only one driver. Yeah? So the first thing we need to know is what drives value. The second thing we need to know, which is so unbelievably critical, yet so many people don't fully comprehend when they start to raise money, is how do investors think? How do investors think? A lot of raising money, there's 2 stages to raising money. There's the preparation period, and then there's the process around it. If you've done the preparation period right and you've got all your ducks in the row, then when it comes to the process, not to make it sound too unglamorous, but it's essentially a glorified sales process. That's what it is. And in order to make a sale, we need to understand who? The customer, the buyer. Totally. Yeah? So we'll go through what are the drivers of value, how do investors think, and then the third thing you need to know is when we actually start to do the discussion with investors, what do we need to put in front of them? Again, something that the vast majority of businesses don't get right. The stats are in Australia, and don't quote me on this because I don't even know where I'm getting the statistic from. I think it might be from AVCAL, the Australian Venture Capital Association. At a small business level in Australia, guess how many capital raisings out of 4,000 succeed?
10%?
One. One in 4,000. Of the people that get educated, like you guys are today, you know, I'd say through MBE, of the people that try and raise money, we have a success rate of probably about 75%. So that's not a plug for MBE, that's a plug for we need to understand the game, because when you understand the system and the process and the game around raising capital, your chances go from 0.00025% to 75%. Yeah? Alrighty. You guys ready?
Yep.
That's a no. Are you guys ready?
Yeah.
Beautiful. Let's do it. Page 1. Page 1. The 4 core drivers of value. So some of what we're going to talk about today, guys, is backed up through research and study and factual data, of which this is one. Who's heard of Wholesale Investor Magazine? Show of hands. A couple of people. Cool. Wholesale Investor Magazine, or a magazine, you list your one-page executive summary in the magazine. Magazine goes out to 10,000 investors. If the investors are interested, they contact you. Yeah, so it's like a matchmaking service, similar to RSVP, but with very different outcomes. I'm not suggesting we all run out and jump on Wholesale Investor. It costs like between $8,000 and $15,000 to do that, so I'm not suggesting you guys do that. I want to tell you about the business because of this reason. These guys survey the database every single quarter, and they ask a whole bunch of questions. So 10,000 high net worth investors, and they ask a whole bunch of questions, which gives us factual insight into the psyche of investors. And one of the questions they ask is, what are the top 4 things you look for when investing into a business? So to me, that equates to what are the top 4 value drivers that are going to influence not only the value of your business, but how attractive it is to investors. Does that make sense? Cool. So let's go through them now. The first one is market. So the bottom circle is market. What space you operate in. You need to be operating either in a growth sector or at least a steady sector. And by steady, I mean it's not declining and it's not at risk of something. Usually technology. Yeah, it's not at risk of technology coming in and sideswiping your business model. So you need to be either in a steady and safe sector or a growth sector preferably. Now, if you're not, you need to amend the business model somehow so that you are. If you're selling VHS players, you're in trouble. Yeah? It was Warren Buffett that says, a rising tide lifts all boats. A rising tide lifts all boats. When there is a strong market and a growing market, all businesses in that market feel the growth of that. Yeah? So the number one thing is the space that you operate in. So not only the space that you operate in, but when it comes time to raise money, how do you communicate and demonstrate that there is a commercial opportunity in this market? The second thing is management. Management. When we say management, guys, what I'm talking about here is essentially team. Yeah? Team. I'm not giving these to you in order. I'll tell you the order of importance at the end. I'm just giving them to you in the order that sort of I think about them. Now, when I say team, I'm not talking about having a HR manager and a business development manager and a recruitment manager and an admin manager and an operations manager and a CFO and I'm not talking about that. Please write this down. Your team is the people within and around the business. Is the people within and around the business. The reason I'm not talking business development manager, operations manager, CFO is why? Well, because often as an early stage business, we might not be able to afford all the managers that we need in the world. Yeah? Exactly. Yeah? So it's about the people within and around the organisation. So the number one method, and this is the most important thing when you go to raise money from investors, is the team. This is number one. And the number one method for you to bolster your board or bolster your team and make it more attractive to investors is to build what's called an advisory board. Build your advisory board, which is essentially a couple of different mentors. They may be paid, they may even be unpaid. You may even put them on targets, and down the track, if targets are met, or you're happy with their contribution, then they might earn in a little bit of equity or something like that. But they don't necessarily have to be paid board members. It's essentially one or two mentors with a title of advisory board. They're not directors necessarily, they're not shareholders necessarily, they're just mentors where you've built a relationship, and that might take 3, 6 or 12 months. It might take 3, 6 or 12 months. But once you've built a relationship, you can have a conversation with people around, look, we're looking to bolster the board of this organisation. Therefore, we're looking to build our advisory board. We really appreciate your experience. We've obviously been getting so much out of the discussions we've been having with you to date. Would you be happy to sit on our advisory board? And it's either going to be not paid, it's either going to be paid a little bit, or it's either going to be, sit on the advisory board for 6 months, and 6 months down the track, we'd like to have a discussion about giving you 3 or 5% of the business if you're happy with it and if we're still happy with it. And you might put some milestones or some targets around that. The reason I said this is the way I think about it is because this is kind of the order in which it needs to be communicated. Is there a market opportunity here that this business can leverage off and capitalise on? Tick box number 1. Number 2, do you have the people required to get the job done? And that will often be, the market will be there, and it'll be there or not. But whether you have the team or not is something that can be influenced. Yeah? So everybody, please write this down. Treat every capital raising as an excuse to build your A-team. Treat every capital raising as an excuse to build your A-team. So in the lead up to the capital raising, in the preparation period, we're looking to bolster up our board. We're looking to get a couple of people that with either industry experience or high net worths, or a CFO with financial nous, or an M&A person if we're looking at an acquisition or an exit down the track. We're looking to bolster that board. During the capital raising, what's another method to further bolster the board? So we might have bolstered the board in the lead up. Then during the capital raising, another way to do that is to bring on smart money. So that the investors we bring on are not just coming with capital, but they're coming with other things that will probably add even more value to our business other than the capital. Now, we differ on this sometimes. Sometimes we get clients who go, Jack, we don't want further input. We've kind of got our board, or we're happy with the team at hand. We just want essentially some passive money, some silent money. We just want the money and we don't want anything else. My view is that 9 times out of 10, if we do a deal for a business that I'm involved in personally, then we will 9 times out of 10 bring on smart money. Please write this down, guys. Half the value that investors bring is non-financial. Half the value that investors bring is non-financial. You guys tell me, what are the other things that a good, smart, experienced investor will bring to your organisation? Contacts, totally. Credibility, absolutely. What else? Experience. That's pretty much the 3 things. Experience, knowledge and credibility, and their network. Very, very powerful. When Janine Aller started Boost Juice, the first person she got on board was a guy called Rod Young. Now, Rod's a guy from DC Strategies. Anyone know Rod? No? Rod's considered the world's leading franchise expert. So he's obviously the founder of a company called DC Strategy, which work with just about every well-known franchise in Australia. He's also the global CEO of Cartridge World. He obviously played a large part in Boost Juice. Hugely successful guy. Rod Young came on board. Jeff Harris was the founder of Flight Centre. Australian billionaire, he came on board. So one of the things Janine did very, very early in the development of her company was she built her team with Rod was advisory board, Jeff Harris was an investor. So two different ways of engaging people, she did both. Yeah? Okay, you guys with me so far? Okay. Market management, and then third, metrics, which is essentially performance. So when we talk about financial performance or metrics, if you're in the early stages of business, and this can be more challenging than if you've got a history, but if you're in the early stages of business and you don't yet have a financial history that you can put on the table, so we're not arguing past metrics, we need to argue, what do we need to argue? Future metrics, yeah? In every capital raising, you should be doing both. If you've got the historicals, you know, that will be a large part of the argument. You still need to be selling the future. If you're a startup business and you can't point to historicals, you need to sell the hell out of the future and you need to make it real. Yeah? Please write this down, guys. Make the future real. Make the future real. I'll give you some examples of not making the future real. So I used to share an office with Wholesale Investor. And so MBE and Wholesale Investor, we would get a lot of executive summaries coming through. We'd get a lot of information memorandums, which is just a summary of a business plan that people use to raise money. We get a lot of documents coming through. So these are examples of not making the future real. One IM came in and on the second page, it said, "We are a shoe business. Everybody in the world has feet. Therefore, if we just get 1% of the market, you, Mr. and Mrs. Investor, are a billionaire." Good? No or no? There was another one which was almost as good as that came through. So this is front cover of the IM. Front cover. Didn't know what the business was. No branding, just this sentence. "We are on track to buy out Google and Facebook." Our first thought is, if you were on track to buy out Google, guess who probably would have bought you by now? Google. Yeah? So make the future real. How do we do that? Historicals will go a large way to making the future real. This is our current growth curve, therefore we can extrapolate it to mean this. How else do we make the future real? If we're a startup business and we don't have any historicals, what market data do you have? And what consumer insight do you have to know the people that you're going to want to go out and speak to? Prior to starting the Entourage, so another business I've got is called the Entourage, and we set up the Entourage to educate business owners under 40. Yeah, so that's not a commercial move for us, and that's what I meant before when I said, if you don't want to sell your business, that's cool, all of this still applies. Entourage is a business we'll never sell. It's not a commercial play, it's something we do because we love it and we think it's necessary. Yeah? It's talking about making the future real. Prior to starting the Entourage, we needed to get a lot of strategic partnerships up, so not investors, but partners that were going to lend their brand to us and all of that sort of stuff. So we needed to manufacture credibility. In order to do that, we ran 7 focus groups. We did some in conjunction with the New South Wales State Government, and we did some independently of the government. But 7 focus groups. So by the end of that, and we had a database from an event we did with Antil, so we surveyed everybody that actually came to that event. So at the end of that, we had a whole bunch of, we knew the market, but then we had a whole bunch of market insight and more importantly, consumer insight, so that our argument as to what we were going to do wasn't Jack's opinion. Actually, a lot of Jack's opinions throughout that process were proven wrong. which is even better than having them proven right. Because had I have gone into that company without doing the market research on Jack's assumptions, we would have wasted a whole lot of time and probably a whole lot of money. Yeah? So if you're yet to start or you're right in the seed stage, one way to make the future real is market and consumer insight. Another way is any partnerships that may come on board if we have this capital. If we get the capital, we've had expressed interest from blah, blah, and blah, parties A, B, and C, and here are some emails that can verify what it doesn't need to be contracted or anything. Here are some emails. It's not in contract yet, but this demonstrates that we're having a discussion with these brands to come on board. So we need to make the future real by providing evidence that what we say and what we assume is going to happen is going to happen. A lot of investors will come at everything from what's called a null hypothesis. Who can tell me what that is? A null hypothesis.
No basis on which you create hypothesis.
Exactly. It's basically any idea is a bad idea until proven otherwise. So if we're saying this is going to happen in the future, we need to substantiate that with real evidence. You guys good with that? Yes or no? Cool. Okay. And then the fourth thing. So we've got number one, market management metrics. The fourth thing, which we're going to just draw a line under your circles like that, is the exit strategy. When investors invest in a private company, a small business, an early stage business, they are not primarily concerned with generating dividends along the way. Meaning they're not primarily concerned with investor invests 200 grand, they get 20% of your business, you generate a profit of $200,000, they get 20% of that profit. So it's called a dividend. They're not primarily concerned with dividends. Now, are they going to argue if you give them dividends along the way? No. Everyone, no one's going to argue with that. However, that's not their main reason for investing. What is their main reason for investing? Totally, exactly right. Please write this down, guys. Capital growth. Capital growth. Meaning I want to invest in this business at a value today, and I want to exit this business 3 years, 5 years, 7 years, whatever that might be, from now, at a higher value, at a higher valuation. We've seen so many pictures where we go, okay, so, like we don't really understand the path to exit in this particular business. What's the return for the investor? And they go, they get shares in the company. And it's not good enough. They need to have a clearly identified path to exit. Need to have a clearly identified path to exit. Now, that path to exit will probably change. It will probably change every year for the next 5 years in an early stage business environment. The potential buyers will probably change, etc., etc., etc. But I, as the investor, need to be very, very confident that you are thinking about the exit and you've identified several potential buyers. We'll talk about that in a second. But you know your path to exit and you know potential people that might buy this business one day. Let me just survey the room real quick. Who is comfortable with one day exiting their business if they could do so for the highest possible price, similar to what Janine Ellis has just done? Okay, cool. Anyone in the room not want to sell their business, which is totally fine? Okay, cool. And this is relevant for everybody in the room who either has a business they don't want to sell or might one day have a business you don't want to sell. It doesn't the exit strategy doesn't necessarily have to be we're selling the whole thing. It's Mr. Investor, you're investing today at a valuation of 2 times profit. We're currently profiting $100,000. You're investing at a valuation of $200,000. In 3 years' time, you will have the option, but not the obligation, to sell your shares back to us at 2 times whatever profit is then, or 3 times whatever profit is then. But it'll be a predetermined valuation method at a predetermined time or milestone, and we will give them the option to exit the business without necessarily selling the whole thing. I told you I'd give you the numbers in terms of order of importance. These are it. Management is the first thing the most important thing on an investor's checklist, the team within and around the business. The second thing is the market. The third thing is the financial performance. And the fourth thing they look for is the exit strategy. At the end of today, we're going to finish with you guys putting together your skeleton of your one-page executive summary. And in doing so, we'll tick all those boxes. The most common method of valuing a private company, or usually any company for that matter, is a multiple of its profit, which is a multiple of EBIT, earnings before interest and tax, so your profit before tax. Now, the average private business in Australia is valued at and or sells for 2 times profit, yeah? So that's the benchmark, that's average. However, it's not good. Remember that 99% of people that do this, 99% of companies that raise money or sell their business do so with 0 education. So 2 is the average, which is exactly that. It is average, or worse than average in my opinion. Anybody that works with people that know what they're doing should not transact for anything below 4 times profit. 4 times profit. So how do you gauge that? We will do a capital raising across MBE Group with something that is a commercial play for us. We will do a capital raising probably towards the end of this year, and we'll do that capital raising at about 6 times profit. In MBE, the person that talks about exit strategies, the person that's on our home study programs for exit strategies is a guy called Dr. Tom McCaskill. Tom has sold businesses for anything up to 28 times profit.
So by that, he's basically factoring in growth opportunity or even profit margins as growth accelerates.
Good thinking, good thinking. However, when you start talking about the 28 times multiples, it becomes no longer about the profit or the margin that you've made in the past. It becomes a conversation of what is this worth to the acquirer. Because in order to get like a 28 times multiple, and I'll talk about this, what you're asking comes down to something called strategic value, which I'm going to cover in the next segment. But if you want to start getting 8 or 10 or 12 or 20 or 28 times multiples at your exit, then you have achieved a conversation about strategic value, which isn't what have we done in the past, it's what is this thing worth to you? Because you can make a hell of a lot more money out of it than we ever did. And that might be, we've got a product, we've been selling it to 1,000 people. You, Hewlett-Packard, have a distribution of millions of people around the globe. Therefore, if you plug this into your distribution, it's not worth X, it's worth Y. So it becomes a slightly different conversation at that point. If it's average, it'll be 2. If it's good, it'll be 4. If it's great, it'll be 6. But there are so many factors, the team, the market, the growth opportunities, etc., etc. But my simple way of viewing it is crap, 2, it's all right, 4, great, 6, strategic value, 8+. So what was the second thing? I started today by saying, in order to successfully raise money, we need to know and do 3 things. What was the second thing?
Know what the investor's asking themselves.
Exactly. Know what the investor is thinking. Know what the investor is thinking. So what we've got here on page 2 is the 3 questions on every investor's mind. The 3 questions on every investor's mind. Now, the investor will be asking themselves these 3 questions. Where entrepreneurs typically go wrong is that if we're inexperienced, we typically answer them in the complete wrong order, which can be a deal breaker. So let's go through these 3 questions. And these are the questions the investor will be asking themselves in that particular order. Question number 1, will I lose my money? So, I'll go back to my next question. What are we not yet talking about? Yeah. We're not yet talking about the blue sky opportunity. The first, will I lose my money? Just make me comfortable that you're not going to lose my money. In any sales process, there's 2 things that we're dealing with. We have to lower something and then heighten something. What do we need to lower? Resistance, fear. There's something called buyer's resistance and buyer's acceptance. Before we go to increasing buyer's acceptance, which is what most people jump straight to, we need to decrease buyer's resistance. So the first thing any investor is thinking when they open an executive summary or when they open your information memorandum or they come to your investor presentation is, am I going to lose my money on this thing? Is this the kind of person that will lose my money? That's what they're thinking. Typically, they might have made a few investments in the past, and in an early stage business, we guys are the most riskiest asset class that an investor can invest into. Now they know that, that's cool. We're also the best asset class for future potential returns. Because if you look at a public company, they might be growing at 8 or 10 or 12 or 14% per annum. If you look at an early stage growth stage business, it might be growing at 300% per annum. Investors are aware that the majority of things, well, maybe not the majority, let's say you invest in 10 businesses as an investor, 2 or 3 will fail, 4 or 5 will, be okay. They'll make a little bit of money, but not great. And then 2 or 3, I don't know if my maths is right, but 2 or 3 will, grow significantly. And they realise that. However, what that doesn't mean is that every 10 investments they look for 3 that's going to lose them money. It just means with their sense of good judgment, they try and minimise the number of businesses that are actually going to lose them money. Yeah? So most people go straight to the blue sky opportunity. Everyone in the world has feet. Yeah? Lower the resistance before we start talking about increasing the acceptance. So the 3 things they're going to look for under will I lose my money? Number 1, proof of concept. Proof of concept. Yeah. So proof of concept might be track record, it might be existing sales, it might be pre-sales, it might be you've done a bunch of consumer insight and been able to identify that yes, indeed, there is a need in the marketplace. If we don't have historicals to point at, consumer insight is a good one. But how can you prove, so it comes back to substantiating the future, how can you prove to a certain degree that what we assume is going to happen is going to happen? Yeah. Number 2, under will I lose my money, is the experience of the business owner. The experience of the business owner. Do you have experience in this space? Do you have business experience, etc., etc., etc.? Now guys, we see a lot of investments at a small level get off the ground with a relatively inexperienced entrepreneur who surrounded themselves with some really experienced and credible people. Yeah. So number 3 is the experience of the team. So by ticking those 3 boxes, we give the investor relative confidence that they are not going to lose their money. Yep. Question number 2. And I'll think about this before I just blurt it out. When will I get my money back? When will I get my money back? So we're still not yet talking about the blue sky opportunity. We're talking about what is the time frame and likelihood of the investor getting their money back. Number 1, under will I get my money back? What is the path to exit? Or what is the exit strategy would be another way of phrasing that. What is the path to exit? Number 2, how committed is the entrepreneur to achieving an exit? Did they just dream up this exit strategy while they were waiting for us in the foyer because someone told them they needed an exit strategy? How committed is the entrepreneur to the exit strategy? And then number 3, what might interrupt our path to exit? What might interrupt our path to exit? So you guys tell me, what might come under this dot point? Technology, yeah. Can what we do be replaced or enhanced by a competitor with technology? Yep. Legislation changes, economic changes are changing the economic environment. Yeah, we need to change the structure of the business or the nature of the business, and that's somewhat risky.
Something personal to the entrepreneur.
Yeah, something personal to the entrepreneur.
Exit of the key people.
Yeah, absolutely. Are there pivotal people in this, which is a risk? Are there pivotal key people in this organisation that are a flight risk? And how do we secure them? That's all 100% right. So guys, when we start to highlight, because what we don't want to do is hide the risks. Why don't we want to hide the risks from the investor?
Because they're already.
Exactly. They've already thought of probably 10 times more than what we have already, because they're looking for risk. So what do we do when we start to talk about it and say, Mr. and Mrs. Investor, this is all of the risks and this is what we're doing about it? What does that demonstrate to the investor? Credibility. Confidence reduces the risk. Transparency is really important. You have a plan. You're thorough. You're professional.
Contribute advice to how you can mitigate some of those risks.
Exactly. They might be able to contribute advice as to how you can mitigate some of the risks. Trust.
If they're smart money, then you want them.
Exactly right. All of the above. It's so important that we communicate the risks, ask them if they see any further risks, and communicate what we're doing to minimise or mitigate those risks. That alone, at a small business level, will make you stand out of the crowd, because it shows you're thorough, professional, thought about the risk, minimising the risk, etc., etc., etc. Question number 3. Will I make money? Will I make money? Here the investor is looking at 3 things. First thing, growth strategy. What is the strategy for growth? So, okay, we're talking about going from $1 to $10 million or $200,000 to $1.4 million, whatever it is. What's the strategy to get there? And this is where we start to introduce any potential partners, any existing partners, any consumer insight, any market data we've got, the new online play that we're going to make that we haven't done in the past, etc., etc., etc. We need to start talking about how we're getting from A to B. Yeah? So growth path, growth strategy. Number 2, strategic value. Strategic value. We were working with a magazine a number of years ago. It was not Anthill magazine. And the magazine wanted to raise money and or sell the business. So we started having discussions about how we could do that. And what we determined in having discussions with this particular magazine was that if we were to value the business at a multiple of its profits, that valuation wouldn't do the magazine justice. So we needed to come up with a different way to value this magazine. The magazine had a subscriber base of 40,000 people. 40,000 people. Some of which were paid subscribers, so $50 a year you get the paid magazine every, I think it was bi-monthly, or you can subscribe for free and you get the online magazine for free. But if you were a paid subscriber, what's the maximum amount you could be worth to this magazine? Yeah, $50 a year. Yeah. So we surveyed the database with what was quite an extensive survey, but we incentivized them with gifts and stuff to fill out this particular survey. What we found with this magazine is that of the 40,000 people, 16,000 of them, 40%, owned property. So we've got 16,000 property owners. Of the 16,000, half, so 8,000 people, listed their number 1 investment choice over the next 12 months as an investment property. So we've now got 8,000 people that own property. So they can obviously service a loan, they might have a bit of equity built up in their property, etc. And they've listed their number 1 investment choice over the next 12 months to invest in a property investment. So we've got 8,000 very targeted, highly qualified potential property buyers. You're a property developer. You make $10,000 per property that you sell. Is this magazine now substantially worth more to you than what our profit and loss statement says for the last 12 months? Yeah? That's strategic value. That's strategic value. To identify the strategic value in any business, guys, ask yourself this one question. Please write it down. If you take nothing out of today, take this. Who can make more money? Who can make more money from this business than I can? And why? In the interest of time, let me just give you a couple of examples. As I said earlier to this gentleman, we might have a product we're selling to 1,000 people. We're talking with an international buyer who might be able to sell it to 10,000, 100,000 people. So it becomes less of what did we do last year and what is it worth to you? It could be the database or the client base of the business. Another company can monetize your client base and database to a far greater extent than you can. So we're working with one example of that at the moment. This particular business, they repair showers. That's all they do, is they repair showers. So strategic buyers for this group is people that offer a whole bunch of different home services, because they'll obviously buy the business of shower repairs and they'll get all these clients of shower repairs, and then they can start having discussions with them about all the other stuff that needs to happen around the house. So the client used to be worth this much a year, sell it to a strategic buyer, the client's now worth this much per year. Yeah, so that's strategic value. We cool with that? I'll ask again. We cool with that?
Yes.
Yeah. The answer can be no, I just need an answer. Yes?
How do you actually validate the fact that the potential exists in the market, or the person who wants to buy it?
So how do you...
Because he's going to underplay that.
Oh, absolutely. Yeah, absolutely. So the question is, how do we substantiate that what we think is going to happen is actually going to happen? Sometimes it will just be a common sense argument. We've got a bunch of clients that do shower repairs. You do X, Y, Z as well. So you could on-sell that to the existing client. Sometimes with strategic value, well, often with strategic value, the acquirer will need to get it. If the acquirer doesn't get it, if the acquirer doesn't agree, then they're not going to pay 28 times. So not everyone will be a strategic buyer. It will need to be a good fit. And I'll give you an example. When Facebook were losing $1 million a month, Microsoft invested. So Bill Gates, one of the smartest business people on the planet, invested into Facebook. Does anyone remember what valuation, WHK people excluded, what valuation he invested at? Microsoft invested, sir? No, they floated at 100. Or 200 million, did you say?
Yeah, maybe it was, yeah.
Yeah.
I said billion, but I know.
Yeah. Facebook were losing $1 million a month. So who's not losing $1 million a month? Yeah, financially you're doing better than they were. Microsoft came in at a valuation of $15.5 billion. Because they understood the strategic value of the relationship. So it's not something that we can go to someone and try and convince them. You know, we will need to communicate it to them and identify our rationale as to why we think that. We might have even spoken to some of their customers. The best way to do what you're talking about is to have a strategic partnership with them in place already. So there's one business that we work very closely with. They know exactly who will buy their business for the purpose of someone else will want this database, and they'll be able to monetize it to a far greater extent than what this business can. And there's 4 or 5 of these potential companies. So in like year 2, they created strategic partnerships, started working with these organizations for the purpose of what they might buy them for one day. So that's probably the best way to do it, because then you build a relationship, they see the track record, etc., etc., etc. They will always try and downplay it. The investor, if they're investing, will always try and downplay it. Whoever's buying your business will always try. So that's the friction that happens. That's That's the disparity between our side and their side of the table, is that negotiation process. Okay, how long have I got?
About 10 minutes.
Okay, good. Number 3 under question 3, guys. Number 3, who might buy this business? Who might buy this business? Ideally, we want to demonstrate that we've identified 3 or 4 or 5 potential acquirers one day of this business. Who can tell me why 3, 4 or 5 is better than 1? Totally. Please write this down. It's called competitive tension. No different to you if you were an auctioneer. The more bidders that you have standing on the street, the higher the price will be driven. So if we can identify strategic value, who can make more money from this business than I can, and find 3, 4 or 5 of those particular businesses, then you've set yourself up for a successful sale. Yeah? Okay. How you guys doing? Good. Alrighty. Crossover, 3rd page. This is your executive summary. So, your executive summary is simply a 1-pager, and again, not to make it sound too unsophisticated, but it is essentially the marketing flyer that you will use to pique the interest of investors. Well, you should have an executive summary, and you should have what's called an information memorandum. So the information memorandum will be a document, it might be 20 to 30 pages, and it's essentially a summary of the business plan that summarises the investment highlights and everything that we've gone through with the value drivers and the 3 questions. It should summarise all of that. Now the information memorandum we're not protective with, but we're more protective with than we are with the executive summary. We don't just show anyone the information memorandum. We need to get some level of interest and some level of engagement before we give someone the information memorandum. The executive summary, this is what we use to email out to our network, and this is what we use to email out to the investors, and this is what just to start the conversation. So this is a 1-pager that in 2 minutes should make the investor go, yes, this is something I want to look into further and investigate, or no, this isn't for me. And either one is fine. Yeah. So guys, what you should all do, this is your action item from today. You've got 1 action item, and that is to complete this executive summary in the next 7 days. Yeah, complete this executive summary, and we'll go through it in a second, but that's the action item, is to complete this in the next 7 days. Now, I'll explain what I mean by that. So let's just go through the different components of the exec summary. The first section, and I know this is weird, the first section is called the executive summary. So you've got an executive summary within the executive summary. It's just how it's done, right? Which is tell us in plain language what the business does. Tell us in plain language what the business does. So an investor or a person or an introducer with no understanding of your industry and no understanding of your business will get, okay, I know what they do, I know why they do it, I know who their customer is. Yeah? It sounds simple, like it sounds obvious. I can't tell you how many executive summaries we see. We read that paragraph and I go, I don't even know what they do. I'm not going to invest the, everybody is so busy, we're not going to invest the time into going onto their website and calling. If they can't tell us in a paragraph what they do, chances are they'll be put to the side. So summarize, yeah, you guys get that? Plain language, what do we do? The next thing is competitive advantages. So what makes you different, better, and how have you achieved proof of concept? The proof of concept part is particularly important if you're a startup business and you can't point to historical performance. So what are the competitive advantages? What makes you different and better to everybody else in the marketplace? We then want to talk about the key investment highlights. So this will just be dot points of what are the top 6, 8, 10 things you can tell me to get me really excited about this investment opportunity. It might be a particular market opportunity. It might be comparative deals. So you sell wine online and you can point to Woolworths bought someone in that space about 2 years ago. I forget who it was. Woolworths paid a lot of money to buy an online wine retailer a couple of years ago. So you might say industry transactions currently occurring. Woolworths acquires blah. Yeah. So comparative deals. What else is happening in this space where you can point to and go, this is a hot sector right now? Growth opportunities. So are there any particular growth opportunities that you can point to? We have just teed up hypothetically you might say, we've just teed up a strategic partnership with WHK Group. They have distribution all around Australia. We do X, they do Y. And so in order to meet this strategic partnership, in order to meet the demand that this is going to create, we need to, invest in people and invest in infrastructure. So there's a particular growth opportunity we've got on the horizon. We need to raise money for just to meet the demand that's going to be coming in as a result of that. Team, have you got some really special people on your advisory board or in the business that you can point to and go, these guys are on board with us? Therefore, that is undoubtedly a key investment highlight. So when we go to raise money next, on our board will be a guy called Peter Davison. Peter seed funded a company, a tech company in the United States. They came to him, wanted $50,000 at a valuation of $500,000. Peter was, in his own words, pretending to be a VC at the time in the States. Wrote him a check for $50K, invested in that particular business. So what percentage did he have? 10%. Company goes on to become PayPal. Sold for $1.5 billion to eBay. Peter didn't own 10% then because he would have been diluted in further rounds, but he might have owned 4 or 5%. Sort of gets irrelevant at that point. Yeah. So when we go to raise money next for an investment play, we go seed investor of PayPal, shareholder and board member. Does that go, okay, does that excite you about this investment opportunity? Totally. Any particular partners that you've got and your strategic value. Strategic value is a big one. Do you represent strategic value to some potential acquirers down the track? Why, if I'm an investor in your opportunity, one sec, Angela, if I'm an investor in your opportunity and I'm coming in today and I know that there's strategic value that an acquirer might come in 3 years, why does that get me not excited? Why does that get me interested? Yeah, because I know that I'm going to invest at this valuation today and we might get this valuation down the track because there's real strategic value with this business. Yes? Go for it, man.
Strategic value point. How do you express that? Do you actually say
identified strategic value in blah, blah. Yeah. So these are just dot points, real simple. So we're not articulating the whole argument or providing modelling or anything. Just give me the dot point. Because this will make me go, yes, I want to research further, or no, I don't. Then need to list your board and management. So the team stuff we were talking about before. I've given you guys 4 people, including yourself. Should have an industry specialist. So this is all written here in the 5 boxes. Should have an industry specialist. You should have an entrepreneur. And by that I mean someone who has preferably built and sold a business in your space for more than what you're looking to sell for. So we're looking to sell for $5 million. This lady built a business and sold it for $12 million a couple of years ago. We're looking to sell for $100 million. This gentleman sold a business for $200 million. So someone with financial integrity that the investor goes, yep, cool, got it. They're helping direct that ship. They're helping steer the ship. A CFO, someone with financial literacy that can help you make financial decisions. And maybe an M&A person. So obviously all you guys are looking at raising money. If you're looking at buying businesses and you should be looking one day at selling the business, you should have an M&A specialist on your advisory board that can help you navigate those different transactions. Yeah? And of course yourself. And then lastly, guys, we list the exit strategies. What are the companies that might buy this business and why? And also, you might want to write in this box, what's the timeline? It might be 3 to 5 years. It might be 3 to 7 years. I know that sounds vague and broad, but it at least gives us an indication of what your intentions are. Okay. Guys, we've still got a bit more to go. James is going to come back up, but that's it from me. How did we find today? Did we all learn something about capital raising? Good. And the number one measure, do you now feel more confident and enabled to actually go out there and start the process? Yes or no? Yes. Awesome. Guys, thank you so much. You've been an amazing audience. Hope to see you soon.